The IRS collected $4.9 trillion last year. A significant portion of that came from Americans who paid more than they legally owed, not because they were dishonest, but because they didn't know the rules. The tax code is 74,000 pages long. The IRS isn't going to call you to let you know you missed a deduction. That's not their job. Their job is to collect what you declare. Here are the 3 biggest ways Americans overpay their taxes and how to stop. Problem 1: leaving pre-tax retirement money on the table. If you have access to a 401k at work and you're not maxing your contribution, you are giving the government money you didn't have to give them. In 2025, you can contribute up to $23,500 to a 401k, $31,000 if you're over 50. Every dollar you contribute reduces your taxable income by $1. If you're in the 22% bracket and you put an extra $5,000 into your 401k, you just legally reduced your tax bill by $1,100. That money grows tax deferred until you withdraw it in retirement. Most people are in a lower tax bracket in retirement than during their working years, so you pay taxes later at a lower rate. The average American contributes about 7% of their salary to their 401k. The maximum is $23,500. The gap between average and maximum is where your tax bill lives. The move: increase your 401k contribution by 1% per year. You'll barely notice the difference in your paycheck, but the tax savings compound over time. Problem 2: missing deductions hiding in plain sight. The IRS offers hundreds of deductions. Most people take the standard deduction, $14,600 for single filers, $29,200 for married filing jointly in 2024, because itemizing seems complicated. But for many Americans, itemizing saves far more. The deductions people consistently miss: state and local income taxes, up to $10,000 in the SALT deduction. Mortgage interest, all of it is deductible if you itemize. Charitable contributions, every dollar donated to a qualified charity reduces your taxable income. Medical expenses, if your out-of-pocket medical costs exceed 7.5% of your adjusted gross income, the excess is deductible. Home office deduction, if you work from home, even part-time, a portion of your rent, utilities, and internet is deductible. Student loan interest, up to $2,500 per year. Health savings account contributions, triple tax advantaged. Contributions reduce taxable income. Growth is tax-free. Withdrawals for medical expenses are tax-free. The move: run both calculations before filing. If your itemized deductions exceed the standard deduction, itemize. This takes about 30 minutes and can save hundreds to thousands of dollars. Problem 3: ignoring the Roth conversion window. This is the most overlooked tax strategy for people with traditional IRAs or 401ks. Here's the situation: when you retire, every dollar you withdraw from a traditional IRA or 401k is taxed as ordinary income. If you have $1 million in a traditional IRA at retirement and withdraw $100,000 per year, that $100,000 is taxed at your marginal rate, possibly 22 or 24%. The Roth conversion strategy works like this: during years when your income is lower than usual, maybe you retired early, changed jobs, had a slow business year, you convert a portion of your traditional IRA to a Roth IRA. You pay taxes on the converted amount at your current, lower bracket. Then all future growth and all withdrawals in retirement are completely tax-free. The window exists because tax rates won't stay low forever. The 2017 Tax Cuts and Jobs Act reduced rates significantly, but those cuts expire in 2026. If Congress doesn't extend them, marginal rates will snap back to higher levels. Every year you don't convert is a year you're betting that taxes will stay low or go lower. History suggests the opposite. The move: if you're in a lower income year than usual, talk to a tax professional about converting a portion of your traditional IRA to a Roth. Even converting $20,000 to $30,000 per year over 5 to 10 years can save tens of thousands in lifetime taxes. Americans collectively leave billions of dollars on the table every year by not understanding the tax code. The code is complex by design. Complexity benefits the government when it causes people to overpay. You don't need a complicated strategy. You need these 3 moves: maximize your 401k to reduce taxable income, run both calculations to decide between standard and itemized deductions, and understand the Roth conversion window before 2026 tax rates reset. Subscribe to Finance Alert Global for weekly alerts on the financial systems that determine how much of your money you actually get to keep.